And good morning. Welcome back, options traders. Well, what's the difference between upside versus downside volatility? Now, if you word this in terms of risk, people seem to get it. But as soon as you disguise it in terms of volatility, people end up interpreting it the wrong way and making things a lot harder to generate profits. So let's go find out a little bit more of this difference between upside versus downside volatility and why you really need to be careful with your hedges, rolls, and morphs. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, quick review of volatility. Remember, volatility is this concept that stock prices are just uncertain. So, here's an Excel demo. It's a computer model. So we're going to look at a stock starting with a $100 price, and we're going to turn it loose for 250 trading days. So you can see that there's 250 trading days. That's roughly the number of trading days in a year. And so even though it started at 100, and mathematically you would expect it to end at 100, that's not always going to be the case. It's just like if you flip a coin 100 times, you might say that you would expect 50 heads, but that's not always going to be the case, even though that's the mathematical expectation. Same thing here. Yeah, we would expect it to be 100, but there can be some drift up or down from it. So let's do it again. Let's take another $100 stock, we'll give it some volatility, and we'll turn it loose for 250 trading days, and maybe we get this. Little different path. Got roughly the same ending spots out here, but certainly different paths. We do a few more. Now we get this, do some more. And finally we end up doing hundreds or thousands and we get this. And if we were to measure these out here, put them into tiny bins, we would get a bell curve. And this is where we're getting our probabilities from in the Black-Scholes model to say what's the probability that an option expires in the money, for example. This is where it's coming from. So let's take a look at a Black-Scholes model and say that the stock is trading for 100. We'll use the at-the-money strike 100. And days to expiration 180 days, so a 6-month option. Risk-free interest rate, let's say, is 5%. Volatility will give 30%. And under these conditions, the Black-Scholes model says that the probability for this option to expire in the money is just a hair above 50%, 50.5%. So here's what our bell curve looks like. Now I have these in terms of standard deviations, and I think most of you know that we have roughly 3 standard deviations on either side. Even though there's technically an infinite number, you start running out after about 3. The probabilities start getting really, really close to 0 once you get above 3. So almost 100% of all of your outcomes are going to occur within plus or minus 3 standard deviations. 0 standard deviations right there is the center of the curve. So notice that if you have, let's say, a call option, you bought a call, you have about a 50-50 shot of it going in the money, landing in the green. Now, some of those are going to be right out of the gates, are going to shoot straight up out here into the green. You're never going to think about hedging them, probably not even going to think about closing them. They're just going to run. Those aren't the ones we're worried about. Those are easy solutions because they're not really a problem. You're also going to have some of these that are going to run straight out of the gate and just head to nothing but out of the money and continue to fall out of the money. Well, those aren't really a problem either. Even though they're losses, they occur so quickly, there's just nothing you can do about them, so you're not trying to hedge, roll, morph your way out of them. So these aren't really a problem either. To really bolster your returns and become better, it's the ones that aren't necessarily in the green, but they're also not that far in the red. So maybe we start off this way with a stock price, we dip into the red, but if we just left it alone, we would find out that it did in fact end up in the money at expiration. This is one of many possible paths that we saw earlier. What if we did it again? Sure, might start out in the red, but if we let it run, this time ended up well into the green. We do it again. Yes, we started out in the red, but we ended up in the green. And so it's these trades kind of in this area right in here that we'd really like to let run, but we'd also like to guard a little bit. And this is the point that most traders miss. They're trying to hedge everything, trying to hedge things that could start out on the bright side over here in the green, trying to hedge these things or morph them somehow that are well out of the money. They're just losing trades to begin with. And those are going to happen. There's nothing wrong with that. That happens to the best of them. It's like being dealt a bad hand in poker. Nothing you can do about it. So don't try to hedge and morph your way out of it. So this whole idea about hedging the downside, here's where traders go wrong. Let's say that our stock is at 100 and they go, oh, let me buy a really high strike put. Now, just to exaggerate it, let's say a lot of traders might even go for the at the money for the 100. But what if we went to higher strike puts? What if we did a 105 put and tried to lock in 5 points above the current stock price? Or the 110 or 120? Well, hey, let's get crazy with it. Let's do the 130 put. Let's really get a great hedge on here so that we can't have, for the most part, won't have any losses. We're going to give it 180 days to expiration. Risk-free rate will keep at 5%. Volatility will keep at 30%. What do you suppose happens to your probability of going in the money now? Because remember, you have a synthetic call option. You have stock plus a put. So this is mathematically the same thing as a 130 call. So we have to say, what's the probability of it going in the money, in other words, being profitable to the upside? Well, now it turns out to be about 6.6%, just under 7%. So we started out here, about a 50-50 shot, and then after we bought this 130 put, we moved to here. Okay, so now all of this area to the right, here in green, this is our 6.6%. So yes, you have hedged all of this risk to the downside, but you've also basically eliminated your chances for any profits. And this is one of the problems that I hear from so many traders, whether it's through coaching calls or through emails. I find that they want to overhedge. They're always trying to hedge without realizing that you are implicitly giving up profits when you do that. So the takeaway from all of this is that downside volatility is required to capture upside volatility. I've also said this in different ways in previous videos, that the volatility of the market is a necessary evil for having profits. That's why profits are there in the stock market that are well above the risk-free rate. It's because of the downside volatility. But anytime you are hedging, you are reducing profits. So that's important. Now, that does not mean that hedging is bad. It just means that we have to be very careful about when and why we're hedging. Now, I could also put this in terms of risk, and I could say that if you reduce your risk, you will reduce your reward. And people say, well, of course, I get that, but then you put it in terms of volatility, and they completely forget about it. It's really the same thing. Volatility is risk. So just remember that when you're seeing this downside volatility or spikes in the VIX, that doesn't necessarily mean that you have to start hedging something, because all you're doing is taking potentially a very big bite out of the potential rewards that are coming from that downside volatility. The trick is, how do you hedge and when? And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.